Okay, ask me. Ask me anything you want. Well, now, except about the time that Hi everyone, Keith Wilson here, founder of Wilson Financial Advisors, and this is...
I'm Annie.
Annie's our branch operations manager, and a couple of weeks ago we submitted a post or asked our viewers to submit questions that they had that they wanted to ask a financial planner for free, and we got a lot of response from that. We're going to answer a few of your questions that you submitted today. So who's our first?
Okay. Our first is from Bridget. She asks, I've heard about a term life insurance policy where you can take money out if you had health problems. What type of insurance is this?
Okay. First of all, term insurance doesn't build cash value, so it's nothing that you can take from that. She's probably referring to what is called an accelerated death benefit rider, which if you had a terminal illness, sometimes a chronic illness, you're able to access part of that death benefit while you're alive. And if you passed away, whatever you took out for that terminal illness rider is subtracted from the death benefit. So that's probably what she's talking about. Next.
All right. The next is from John. Well, this is a good one. What is a bond?
Oh, okay. Well, you got 3 or 4 hours to spend, I can tell you. What is a bond? Let's just make it simple. So a bond is a debt that the company has. So when a company wants to raise money, maybe to build a plant or whatever, they'll issue a bond. Individual investors that buy that bond, they become like a bank. They're loaning money to the company. And in return, they're paying you interest, usually on a semi-annual basis. And now there are different terms. You could buy 5-year, 10-year, 20, 30-year bond. At the end of that term, you get all your money back that you invested in. Of course, you've had interest all that time. But there's government bonds, municipal bonds, corporate bonds. But think of it as a debt that the company has. You buy a bond, you become like a bank, and you loan them money.
All right. Next one is from Julie. She asks, what is the difference between the Dow Jones Industrial Average Index and the S&P 500?
Okay, these two indices are the main ones that people look at when it pretty much gauges how the stock market is doing. The Dow Jones is consisted of 30 individual stocks, U.S. large companies, and it's price weighted, meaning they look at the individual prices of those 30 stocks divided by divisor, and that's how they come up with the index. The S&P 500 is consisted of how many, you think?
I'm going to go with 500.
500 is correct. 500, there again, U.S. large company stocks. It's market value driven, meaning they look at the value of each of those 500 stocks. So when a company has a 10% change in their stock price and it's a $20 stock, and another company has a 10% change, but their stock is $100, it is equally weighted. But these are the two that people look at most when you hear the market's up, the market's down. They're talking about the S&P 500 or the Dow, but there are a lot more out there. Small caps, large caps, mid-size, international bonds, indexes, and so forth. But those two are the most popular ones. I know I saw about 100 more, but we're not going to finish all of those today. We'll get to them later. But I want to thank you folks for sending in your questions. And if you have further questions, feel free to contact me, and I can discuss your unique needs and circumstances. And thank you, Annie, for dropping by.
Thanks for having me.